Something unusual is happening in the silver market right now, and if you are watching the screens carefully, you can feel that tension building in real time. Prices are not just rising, they are jumping, pulling back, then surging again, with a speed that reminds me of the early stages of past commodity dislocations. I have followed metals markets for years, and movements like this rarely happen without a deeper structural shift underneath. When a market begins to behave erratically, while still trending upward, it is often a signal that the system behind the price is under strain. Look closely at what the market has been telling us in recent weeks. You see sharp intraday swings, sudden spikes, followed by fast corrections, and a persistent refusal of prices to return to earlier ranges. At the same time, inventories are falling in several major trading hubs, and the physical market is showing signs of tightness, even while paper trading volumes remain enormous. These are what I call broken signals, indicators that normally move in harmony beginning to drift apart. When volatility rises, but prices remain elevated, it often means the market is not simply speculating. It is struggling to find equilibrium. To understand why this matters, you need to step back and look at silver's unique role in the global economy. Unlike gold, which functions primarily as a monetary metal and a store of value, silver sits at the intersection of finance and industry. It is used in electronics, solar panels, electric vehicles, and a growing range of advanced technologies. That means silver responds not only to fear and currency debasement, but also to industrial expansion and technological demand. When both forces align, when investors seek protection while factories and energy projects continue consuming supply, the pressure on price becomes asymmetric. History shows this dynamic clearly. In the late 1970s, silver surged not only because of inflation fears, but because supply constraints collided with rising industrial use, creating rapid price acceleration and violent volatility. Now, as we look across the global landscape, we see confirmation coming from multiple directions. Central banks continue to hold large balance sheets, sovereign debt levels remain historically high, and real interest rates, while fluctuating, are not high enough to fully offset inflation expectations in many regions. At the same time, geopolitical tensions and trade fragmentation are encouraging nations and institutions to diversify reserves and secure physical resources. When liquidity remains abundant, while trust in currencies erodes even slightly, metals markets tend to react first, often before the broader public fully recognizes the shift. But here is the contradiction that makes this moment so fascinating. Equity markets in several major economies remain resilient. Corporate earnings in key sectors are still strong, and headline inflation numbers have moderated compared to previous peaks. On the surface, this does not look like a crisis environment. Yet beneath that calm surface, borrowing costs remain elevated relative to growth. Debt servicing burdens are increasing, and supply chains for critical materials are tightening in subtle but measurable ways. This creates a strange dual reality. Markets projecting confidence, while structural stress quietly builds underneath. And that is why the pattern you are seeing in silver matters. It is not just a price chart moving up and down. It is a signal from one of the most sensitive commodities in the global system, reacting simultaneously to monetary conditions, industrial demand, and geopolitical uncertainty. When a metal with such diverse drivers begins to behave this way, it often reflects forces that are larger than any single market. I am not here to tell you what to buy or what decisions to make, but I can tell you from experience that moments like this deserve attention. Because when silver starts sending signals this loud, it usually means the global financial system is beginning to shift in ways that only become obvious to everyone much later. What you are witnessing in the metals market cannot be separated from the larger macroeconomic environment. And I want you to picture this clearly, because the forces driving silver and gold right now are not isolated events. They are the result of years of accumulated pressure across the global financial system. When I look at the data, when I watch bond markets, currencies, and liquidity flows, I see a structure that is still carrying the weight of enormous debt, persistent inflation, and a monetary system that is not fully normalized since the shocks of the early 2020s. You need to understand something fundamental about the modern financial world. Governments today are operating with debt levels that would have been considered extraordinary a generation ago. In many advanced economies, sovereign debt now exceeds the size of the entire national economy, and servicing that debt has become one of the largest line items in national budgets. When interest rates rise, even moderately, the cost of maintaining that debt rises sharply. This creates a constraint on central banks. They must fight inflation, but they cannot tighten aggressively without risking financial instability. This balancing act is not theoretical. It is visible in policy decisions across the United States, Europe, and parts of Asia. At the same time, inflation, although lower than the peaks we saw earlier, has not disappeared. Core inflation in many regions remains above official targets, and wage growth continues to embed price pressures into the system. Energy markets remain volatile. Food prices are sensitive to climate and geopolitical disruptions, and supply chains are still adapting to a world that is fragmenting into regional trade blocs. Inflation today is not just a temporary spike. It has structural components, and markets are beginning to recognize that reality. Now, look at currencies. The strength or weakness of a currency is not just a reflection of interest rates. It reflects confidence in fiscal sustainability, trade balances, and long-term purchasing power. The US dollar, which has dominated global trade and reserves for decades, still holds a powerful position. But the trend toward diversification is real. More countries are settling trade in alternative currencies. Central banks are increasing gold reserves, and regional financial arrangements are expanding. This does not mean the dollar is collapsing, but it does mean the global monetary system is becoming more complex and less centralized than it was in the past. Liquidity is another critical piece of the puzzle. Despite periods of tightening, the global money supply remains enormous by historical standards. Central bank balance sheets are still elevated, and financial conditions, while tighter than a few years ago, remain accommodative in many sectors. When liquidity remains abundant while inflation erodes purchasing power, investors and institutions naturally look for assets that preserve value over time. This is not speculation. It is a rational response that has been observed repeatedly throughout history, from the inflationary 1970s to various emerging market crises. Bond markets are also sending signals that you should not ignore. Real yields, the returns investors receive after accounting for inflation, have fluctuated but remain historically sensitive. When real yields fall or fail to rise meaningfully, non-yielding assets, like precious metals, become more attractive in relative terms. This relationship has been documented for decades, and we are seeing elements of it play out again. At the same time, bond markets are stabilizing after a period of extreme volatility, which creates an unusual environment where both risk assets and defensive assets can rise simultaneously. And here is the contradiction that many people miss. Equity markets, especially in technology-driven sectors, continue to perform strongly. Corporate earnings in key industries remain resilient, and economic growth, while uneven, has not collapsed. On the surface, this looks like a stable environment, but underneath, fiscal deficits remain large, debt continues to accumulate, and geopolitical tensions, from Eastern Europe to the Middle East to the strategic rivalry between major powers, are not fading. These pressures do not always appear in headline economic indicators immediately, but they shape long-term capital flows and risk perceptions. You also have to consider the structural transformation taking place in the global economy. The transition toward renewable energy, electrification, and advanced technologies is increasing demand for certain materials, including silver. At the same time, mining investment has not kept pace with projected demand in several commodity sectors. When demand grows steadily while supply responds slowly, the imbalance can persist for years, gradually tightening markets until price movements begin to reflect the underlying scarcity. So, when you see silver and gold trading at elevated levels, do not think of it as a single event or a short-term anomaly. What you are seeing is the visible surface of a much deeper set of macroeconomic currents: debt, liquidity, inflation, currency dynamics, and geopolitical uncertainty, all interacting at the same time. I have watched cycles like this before, and one thing is always true. The signals appear in fragments at first. scattered and easy to dismiss. But when you step back and connect them, the picture becomes unmistakable. The global financial system is not collapsing, but it is evolving under pressure, and markets like silver are often the first places where that pressure becomes visible. Right now, I need you to focus on something that most people never see, because the real story in silver is not only the price you see on a screen, it is the machinery behind that price. And that machinery is beginning to strain in ways that remind me of several historic dislocations. When markets are functioning normally, the physical supply of a commodity and the financial instruments tied to it move in rough alignment. Prices rise or fall, inventories adjust, and volatility remains within predictable boundaries. But when that relationship starts to break, when price behavior becomes erratic while inventories fall and delivery pressures increase, that is when experienced observers begin to pay very close attention. Look at what has been happening in recent months. Trading volumes in futures and options markets have exploded at certain moments, creating sharp intraday swings that feel almost violent. Prices can move several percent in a single session, sometimes reversing just as quickly. This kind of movement is not just speculation, it often reflects stress within market structure itself. When leveraged positions, options expirations, and liquidity conditions collide, they can create sudden surges or collapses that appear irrational to the casual observer. But to those who have watched commodities for years, these events are recognizable signals of a market searching for equilibrium while supply conditions tighten beneath the surface. Now, consider the inventories. Registered stocks in some major exchanges have been declining, and the physical market in several regions has shown signs of tightness. Backwardation, when near-term delivery prices exceed future prices, has appeared at times, and historically that condition has been associated with immediate demand exceeding available supply. This is not a theoretical concept. We saw similar dynamics in energy markets during supply shocks and in precious metals during periods when investors and institutions rushed to secure physical material rather than rely on paper claims. And this is where one of the most important contradictions emerges. The majority of trading in silver does not involve physical bars changing hands. It happens through derivatives, futures contracts, and financial instruments that represent claims on metal, rather than the metal itself. This system functions efficiently in stable conditions because only a small fraction of participants ever request delivery. But when confidence shifts, when more participants begin to demand physical settlement, or when inventories decline to uncomfortable levels, the ratio between paper claims and available metal becomes a critical vulnerability. History offers examples of this tension, from commodity squeezes in the 20th century to more recent disruptions in various resource markets. You also need to look at the global dimension of this phenomenon. Price signals are not uniform across regions. In some markets, physical premiums have risen above benchmark prices, and arbitrage flows have begun pulling metal from one region to another. This is a classic symptom of imbalance. When the same commodity trades at noticeably different prices in different locations, it means supply chains are under pressure and demand is unevenly distributed. We have seen this before in oil markets, in agricultural commodities, and in metals during periods of rapid industrial expansion. At the same time, options markets have introduced another layer of volatility. Large positions near expiration dates can force rapid hedging activity, creating what traders sometimes call gamma-driven moves. These events can accelerate price swings dramatically, pushing markets far beyond what underlying fundamentals alone would justify in the short term. But here's the key point I want you to understand. Volatility itself is not the signal. The signal is volatility combined with persistent upward pressure and declining inventories. That combination has historically preceded some of the most dramatic commodity moves in modern financial history. And yet, despite all these warning signs, the broader public conversation often remains focused on daily headlines or short-term fluctuations. This is another contradiction. Structural stress can build quietly for long periods before becoming obvious. In the late stages of previous commodity cycles, markets often appeared chaotic and confusing just before major breakouts or corrections reshaped the landscape. The same pattern can be observed in currency crises, in bond market disruptions, and in equity bubbles approaching their turning points. So what does all of this mean when you step back and look at the full picture? It means that the strange behavior in silver is not random noise. It is the visible expression of deeper forces, tightening supply chains, leveraged financial structures, global arbitrage flows, and shifting confidence in the balance between paper and physical markets. I am not here to tell you what decisions to make, but I can tell you that markets rarely send signals this persistent without a reason. When volatility becomes the norm, when inventories fall, and when price behavior diverges from historical patterns, experienced observers recognize that something fundamental is changing beneath the surface, even if the full consequences have not yet revealed themselves. Now, I want you to shift your attention forward, because what matters most is not only what has already happened in the silver market, but what the signals in front of us are beginning to suggest about the months and years ahead. When a market starts behaving in this way, persistent volatility, structural tightness, and strong long-term demand, it forces everyone who watches macroeconomics to ask the same question. What happens next if the underlying pressures do not ease? The first factor you have to watch is monetary policy. Central banks across the world are in a difficult position, and you can see this clearly if you look at the data rather than the headlines. Inflation has cooled from its peaks, but it has not returned comfortably to target levels in many major economies. At the same time, economic growth is uneven, debt levels remain historically high, and financial systems have become extremely sensitive to interest rate changes. This means central banks cannot tighten aggressively without risking liquidity stress, but they also cannot ease too quickly without risking another wave of inflation. That tension keeps real interest rates in a narrow and unstable range. And historically, environments like this have been supportive for hard assets. The second factor is capital flows, and this is something many people underestimate. Institutional investors, sovereign wealth funds, and central banks move capital in ways that are often invisible to the public until months later. When central banks increase their gold reserves, when large funds rebalance toward commodities, or when emerging economies diversify away from single currency dependence, those flows can reshape entire markets over time. These are not short-term trades. They are structural reallocations, and once they begin, they tend to persist. You also need to consider the industrial side of the equation. Silver is not only a monetary metal, it is a critical material in the modern technological economy. The expansion of solar energy, electrification, advanced electronics, and emerging manufacturing process continues to increase baseline demand year after year. Unlike financial demand, which can surge and retreat quickly, industrial demand tends to be steady and cumulative. Mines cannot be developed overnight, and production cannot expand instantly to meet rising consumption. History shows that when supply growth lags structural demand, markets can remain tight far longer than most forecasts anticipate. And yet, I want you to understand that no market moves in a straight line. There will always be corrections, sudden pullbacks, and periods when sentiment shifts abruptly. Bond yields can spike, liquidity conditions can tighten, and speculative positions can unwind rapidly. We have seen this pattern repeatedly, from commodity cycles in the early 2000s to precious metals in previous decades. Volatility is not an exception in these environments. It is the rule. There is also a geopolitical dimension that cannot be ignored. Resource nationalism, trade fragmentation, and competition for strategic materials are shaping policy decisions across continents. When countries begin restricting exports, stockpiling resources, or prioritizing domestic supply chains, the global market becomes less efficient and more fragmented. Prices then reflect not only supply and demand, but also political risk, transportation constraints, and regional imbalances. These forces do not disappear quickly. They build over years, gradually reshaping the structure of global trade. And here's the contradiction that should make you think carefully. On the surface, the global economy continues to function. Markets open each morning, trade flows continue, and economic indicators move within ranges that appear manageable. But beneath that surface, the system is carrying enormous levels of leverage, debt, and structural dependency on continued liquidity. This is not a prediction of collapse. It is an observation of fragility. Systems like this can remain stable for long periods, but when pressure builds, the adjustments tend to be abrupt rather than gradual. So when you look at silver today, do not see only a commodity chart. See it as a barometer, a sensitive instrument responding to monetary policy, industrial demand, geopolitical tension, and shifts in confidence across the financial system. Markets like this often detect changes before they become visible in broader economic statistics. I am not here to tell you what actions to take, and I am not offering financial advice. But after years of watching cycles rise and fall, I can tell you one thing with certainty. When multiple macroeconomic forces begin to align, and when a market starts behaving in ways that break historical patterns, it is rarely noise. It is usually the sound of a system adjusting to a new reality, one that most people only recognize after the change is already well underway.